Hello traders everywhere, Adam Hewison here, co-founder of MarketClub with your 1 p.m. market update for Monday the 18th of July. Well, here it is, it's Monday, and we are no closer to solving the debt problem than we were last week. Europe is still a disaster, and that's been reflected in the bank stocks today. I was thinking over the weekend, what would happen if everybody moved out of Greece? What would happen to the debt? Who would pay it? I know it sounds weird to say that, but the reality is, in the Eurozone, you do have the freedom to move and work into other countries. The world has changed, yet the politicians still think it's the same game. In the world of the internet, you have the opportunity to move practically anywhere that's advantageous to you. Having a country like Greece, which is so far underwater that they're never, ever going to bail themselves out, so why not just walk away from the debt? Unless you're a factory worker or a farmer and you're not able to move out of Greece, you're stuck with the problem. But for most well-educated Greeks, mobility and language power make it easy for them to move to another country in the Eurozone and work. If that happens, there will be even a smaller tax base to pay back Greece's debt. The truth is, we all know that the debt is never going to be paid back. That's why the politicians are using all these smoke and mirror tricks to make us think it's workable. It's not. Today's markets reflect what I've been saying all last week, and that is the bank stocks are awful to hold right now. BAC is under tremendous pressure today, down over 3%, and Morgan Stanley and other bank stocks don't look much better. Gold and silver, on the other hand, have just moved in the opposite direction as we expected they would, with gold moving over $1,600 an ounce for the first time ever. Silver led the way for the precious metals and is up over 3%. Silver is moving higher and faster than gold, percentage-wise. So let's take a look at these markets in more detail and work out some target zones for gold and silver, and also some of the bank stocks. We'll be looking at those today. Now, let's go to the markets and see how we can protect and make your money grow in 2011. First up, we're going to be looking at the S&P 500. We've talked about this market. I'll go to the 6-month chart. We've talked about this market. We talked about the 50-day highs, which we showed you several times right here, here, and here. We expected the market to move down. It's moving down. It's broken through the SAR. That's the parabolic SAR right here, which is an indicator you can use. But we also said when we're up towards the highs, and you can go back and check our 1 p.m. updates to see exactly, we're not making this up. We felt this is a very important high, and I don't think we're over this market yet. If you look at how far we can come down from here down to here and from here to here, I think you would get several more weeks, perhaps, of this market being under pressure. There's a couple of other things that really are concerning to me, and that is we've talked about this, the 200-day moving average, which just comes in here, which is right around 1277.45 right now. And also you've got a long-term positive force line since March of 2009, excuse me, not last year, March of 2009. Those are very, very important elements. The other element that I'm looking at, I want to take everything off the screen and clear this up, and that is I'm going to go to the monthly chart here, and let's scope this out a little further, do max, and I'll scope this down because really what I'm seeing here is really quite disturbing, is the fact right down here, this is when we hit the lows in March of 2009 when we were going to heck in a handbasket, and we had a big rally from there. Of course, the trade triangles picked that up beautifully, and I'll just show you, just boom, there's the trade triangle. It came in right there in April and at 888 and got out very good levels at 1044 and then back in here. So anyway, you can see we haven't got a sell signal yet on the monthly trade triangle. That's what we're looking for. But what I am looking at right now is the fact that we're coming from an overbought condition. Just like it was oversold here, we're now overbought. And you can see this is a monthly chart. You can see how the market right now is at a 6-month low closing wise. 1, 2, 3, 4, 5, 6. If we close down here, which is just below 1300, it would be the lowest close in 6 months. Definitely something to be wary of. So again, be on the defensive. Very, very much so. And when we talk about our trend lines from the March lows, I'll just put that in for you very quickly, and you'll see this. There you go. That coupled with the 200-day moving average, which is right at the same level, is going to be a really important area for the people to look at, for traders to look at, especially professional traders and anyone who's watching this video. So let's take everything off the screen, take our trade triangles off, we'll take the trend line off. It's easy to do with MarketClub, and we'll go back to a daily chart, then we'll go back to our next market, which is very exciting. We've been talking about these markets, the silver and gold markets, and they've really been doing extremely well. So let's go to our next market, which is right here. You can see silver's broken out. We've got a nice base. We've talked about this being an energy base, which is right here. And we are looking for, let me just do a couple of things. So the energy base, we've talked about the energy field, the base right here is breaking out. It's a new high, very, very, very positive, over 40. Now the question is how far, how high can this go? Well, it can go as high as it wants, but I want to look at one measuring tool that you may be familiar with when I share with you, and it's called the Fibonacci. And it's quite easy to use. You simply go to the tool here. That's the trend line tool. Then next to the trend line tool we just used, this is the Fibonacci tool. A little yellow box will come here. Then you just grab on the very high point and just pull down to the low point, which is right here. And with the Donchian channels, it makes it easy. And you can see 43.12, around 43 would be a 61.8% correction. If 50% would be 41. So we're getting into the area, but certainly we could go a little higher before this is maybe over with for the time being. But the metals look very, very good right now. So let's go to our next metal market, which is obviously gold, which is very exciting. And gold, as you say, we were looking for this market to break out. If you put our trade triangles in here, you can see basically they captured this move very nicely from this level right here. Oops, let me take that off the screen. That's the Fibonacci tool. But you can see right from here, from 15.57, so over $50 profit in this market right now. And you can see it just works really, really well. And gold, longer term, we've been long this market from 14.30. These are trade triangles. These can help you get in the market, stay in the market, and make money. They're very powerful, easy to use, and they happen dynamically. We often get the question, well, do we put these in afterwards? No, they happen during the market hours. So let's go to our next market. And by the way, gold, we are looking for this market to go up to about the 1640, 1650 area before it has a correction. So I think we can see more two-way action, but certainly the action is very positive. As you may recall, on Friday we said this is a perfect candidate for a weekend trade. The market closed on Friday. It's going to use this last price here, and it closed at 15.93. So you can see it's got $10 profit in it right now. And traders are going to come out of this market tomorrow morning when we open up in New York. So let's see how that works out. But again, 1640, 1650 is our target zone, interim target zone. I might add it's an interim target zone. So let's go to our next market, and that's going to be the crude oil. Crude oil stuck in a trading range, really not much going on. It's just really kind of boring right now. You can see there's not much happening. We want to look perhaps to go long if we get the right indicators. We're getting a little bit oversold, but not there yet. Not much going on. Let's pass on that one really quickly because I want to talk about the bank stocks. This is the CRB Jefferies Index. Again, looks like it's going sideways. Really not much going on. It's plus 55, meaning it's a trading range, and we are not really we're not even oversold. We're a little bit overbought, but certainly not oversold. I would say just let's give this a pass. Let's go to our next market, which is going to be this is Bank of America right here, and you can see with our trade triangles we've been short from 13.16. Market's trading at 9.63, down a bunch today, down over 3% last time I looked. You can see our shorter term signals, the weekly came in at 10.48. Nice profits in this market. How low can it go? That's the big question. I think they can go a lot lower. In fact, if we go to the max on our charts, and I'm going to take these off because we don't need them, and I'll just take the other Donchian channel off as well, and the parabolic. So we get it pretty simple. I'm just going to go with a very simple line chart, but you can see back here we traded all the way down to, it looks like down to less than $5. So I think we got down to $3.50. So I could see this going back down to $5. I really can. And based on this sort of pattern, the sort of revolving pattern, it looks like it's ready for a test of this lows that was set in March. So let's see how that works out. This is the 200-day moving average. You can see it's pointing down, which is not a good sign for this market. But generally speaking, the bank stocks look bad. They look like they want to go lower. Now they're very oversold, which is not unusual, but they're just eroding. This is what happens in a bear market. They just erode, and I think that's what we're seeing right now. So let's go to our next market, which is also a bank stock, Morgan Stanley. Pretty much the same picture. You can see this is the low back in March, somewhere around the, let's just get the low here. Looks like around $10. And we can see that it has rallied nicely. Of course, the trade trial has picked that up nicely. You can see, but we also said, look, where we want to go. And we are short from 2670 on our trade triangles. The monthly trade triangles market's currently trading at 2040. But look at how these trade triangles can help you. This was to get out of any long position, 54.90. You would have gotten back into Morgan Stanley at 23. So it's just $31 you would have picked up right there in terms of either you short the stock or you basically want to go long. From 23.42, you're out at 28.75. So that's a little over 10%, 12, 14%. You're out of the market now. You get back in at 27.77. Then you're out at 26.70. So you lose $1, about 5%. So that's the key thing. You're not going to get killed using these trade triangles even when they're wrong. They're not right all the time. But even when they're wrong, you're not going to take huge losses. The idea is to be diversified and to use these stops. Hey, but I want to tell you something very quickly before we say goodbye. And that is, well, let's follow the bank stocks for sure. But that is this Wednesday at 5 p.m. Eastern Standard Time. I want you to be part of our TV show. We have a telephone number, 410-867-2100, extension 129. You can call in, leave a message, ask a question. Tell us about the success you're having using MarketClub. Tell us about how you use MarketClub. And if you're not a member, ask about how the markets that you're interested in. We'll do our very best to get you on the air this Wednesday at 5 p.m. So that's when we shoot the show. We want you to be part of it. Adam Hewison for MarketClub. Thanks for stopping by. Every success. And I'll see you tomorrow at 1 o'clock.